The Fed announcement yesterday is projected to see less GDP growth and potentially even higher inflation. Powell saying the key factor for the significant fall in GDP estimate for 2025 is those tariffs that the president is recommending. And he says it could cause economic contraction, at the same time increase prices for U.S. consumers. Well, these revisions by the Fed are small in absolute numbers, but could be pretty significant. It's a 10% reduction in GDP growth than they had originally estimated. And some experts warn that could increase the inflation rate by almost 10% above what they were expecting.
So the stock market reacting positively to the announcement by the Fed, and the S&P was up 1%. Again, this was yesterday, so in the red right now, but again, yesterday. Long-term rates also falling slightly, but clearly it appears that the Fed is issuing some warning signal. Anything under 2% growth is recessionary, and that's what they're estimating now for this year. Inflation is above their target. That was 2%, which means that there could be interest rate hikes in the coming months. So again, Fed rate, the interest rates are staying where they are, 4.25, between 4.25 and 4.5%. All right. That's a lot. We know. That's why we have David Hebert here. He's an economist at the American Institute for Economic Research. And Francis Stacy is an economic strategist. Thank you both for being on. So, Ms. Stacy, I'd like to start with you, if I could, on this. Thoughts on the current state of the markets? Again, the fear that interest rates may go up. There is talk of a potential recession. Will there be? Won't there be? Talk of how tariffs affect all of this. Can you wrap this up for us?
Sure. So importantly, the S&P 500 has repriced sort of this tariff type threat to markets, but really it's an adjustment in growth. The growth trajectory is moving lower, and the fiscal adjustments from DOGE, if they should lower fiscal spending, we don't have numbers exactly yet, significantly, that's going to weigh on growth because, as Scott Bessent said, we've been drunk on public spending as far as the stock market goes. Notably, it has not taken out the September low from before the election. And then if it does take out the September low, we have an August low to see if the S&P 500 holds support. It looks like it's stabilizing here after this repricing. The most notable thing that happened yesterday with the Federal Reserve is that they are going to slow their balance sheet runoff. That is actually, that's not quite quantitative easing. They're not buying bonds, but they're letting those bonds run off the balance sheet at a slower pace. What does that mean? They're keeping more liquidity in the market, which means that whether he says he is or isn't, he is thinking about those fiscal spending cuts. And inflation has been decelerating since February. So we're looking for a further deceleration in inflation. There are some lags in some of the goods and services in CPI. Maybe the one-time price adjustment from tariffs could cause a reacceleration. But right now we have decelerating inflation and decelerating growth.
Also, keep in mind with those tariffs, right? We've heard President Trump propose them. And then the EU, for example, was going to hit back with those retaliatory tariffs. And now they're backing it off, delaying those 50% increase on American whiskey. So maybe they had some fans of whiskey overseas fighting back.
Someone spoke up.
Exactly. Let's pivot to this. The CEO and chief strategist of QI Research, Danielle Martino Booth, joined Rob Schmidt yesterday. Here's what she had to say about the economy. Let's watch.
You are absolutely correct. The Biden administration left the U.S. economy on a much weaker footing than what most in the media portrayed it to be. We are seeing that truth come out. We're seeing history be rewritten with every downward revision that we've seen to payroll growth that's coming out starting in 2023 and through 2024. And you're right. We may have to deal with some short-term pain to get to long-term gain, but I have faith in the current administration as well as the wisdom of Treasury Secretary Scott Bessent for looking out for the long-term prosperity of hardworking Americans and putting this country on more stable footing.
David Hebert, would you mind expanding on that analysis there?
Sure. So the argument is quite simple. The idea is that there will be short-term pains from these tariffs and these, changing daily tariffs as reflected, as we've seen in the stock market. And so, but the idea that President Trump and his administration has floated about is that this is going to be worth it in the long term once we reshore manufacturing jobs, once wages start to rise. The unfortunate thing, though, is that this is not the first time people have made the claim that short-term pains will beget long-term gains vis-a-vis tariff and protectionist policies. The reality is that these long-term gains never quite materialize. America never quite recovers from them. Now, I've been critical of Jerome Powell in the past, especially on this program. I think he should be doing more to get inflation under control. But I think he was exactly right yesterday to say, hey, we need to take a pause and wait and see where the dust settles on all these tariff issues and on the federal government cuts. The last thing that the Federal Reserve wants to do is to hike interest rates and cause a recession today that doesn't have to happen.
Yeah, no one wants that. David Hebert joining us and Francis Stacy. Thank you both. We do appreciate your expertise.
Thank you.
More legal trouble for President Trump.